All right, let's jump right into this explainer because right now, early July 2026, the cryptocurrency market is an absolute battleground. We are caught right in the crossfire, with Bitcoin hovering at a highly critical juncture, right around $62,517. The market is taking some serious hits, for sure, but it's also throwing some massive counterpunches. So let's break down this chaos. So let's dive into this high-stakes clash. What we're really looking at here is an epic tug of war. On one side, searing macroeconomic fear. On the other, deep structural institutional adoption. And literally everyone is asking the exact same question. Is this 62K defense line about to completely break? Or are we looking at the ultimate accumulation zone? Well, to figure out what happens next, we have to look at the raw data driving all this panic. And the reality right now, it's pretty stark. A staggering 75.74% of users currently hold a very bearish sentiment. You see, the recent market action wasn't just some quick flash crash that we brush off. It's been a slow, sustained bleed, and that has fundamentally shaken investor confidence across the board. And that sustained bleed has dragged the crypto fear and greed index all the way down to a score of 11. That is deep, deep into extreme fear territory. The market is just pulsating with anxiety right now, driven by a few key factors that we're going to break down step by step. But first, let's look at exactly how much pain active traders are actually in. Take a look at Bitcoin's AVIV indicator. It's dropped to 0.8. In practical terms, this means the average active investor is bleeding. They're sitting on a painful 20% unrealized loss right now. Now, while historical bear market bottoms have absolutely seen this dip even lower, a 20% loss is still more than enough to create some serious market friction. And this valuation discount zone, it's creating a massive headache, overhead resistance. Specifically, the average cost basis for investors sits right near $76,700. So what that does is create a massive ceiling of buyers who are desperate to just break even. Every single time the price pushes up, these trapped buyers are tempted to sell just to stop their pain, and that severely caps any upside. Act 1, the attack of the bears. First up, we are witnessing a massive $10 billion stablecoin liquidity drain. The total market cap of USD stablecoins has shrunk down to $300 billion, with major outflows from heavyweights like USDC and USDT. Look, this is the ecosystem's dry powder. When this capital leaves crypto to rotate into things like the US stock market, it severely weakens the buying power we need to sustain any sort of Bitcoin rally. Adding to that, we just witnessed an unprecedented $4.51 billion in record ETF outflows during June. This completely shifts the narrative we've been hearing. It proves that institutional investors aren't just unconditional, permanent buyers. No, they will actively manage their risk when the macro environment gets tough. And on top of that financial drain, external shocks are heavily dampening risk appetite. On the geopolitical front, Iran has issued stern military warnings against foreign presence in the Strait of Hormuz. Meanwhile, the crypto ecosystem itself continues to face frustrating internal threats. We just saw a nearly $800,000 USDC exploit on the decentralized protocol Hinkle, plus a massive €1.5 million crypto fraud operation dismantled by French police. Incidents like these, they keep traditional investors totally on edge. Furthermore, Tether CEO Paulo Arduino recently fired a bit of a warning shot about an AI sector bubble. He pointed out that the economic depreciation cycle for computing assets like GPUs is only about 3 to 5 years. He's highlighting a really dangerous structural disconnect here between skyrocketing AI token prices and the rapidly depreciating value of the actual hardware behind them. Act 2, the tech and regulatory shields. But hey, despite the extreme fear, the underlying fundamentals of the market are actually hardening. The first major shield came in the form of macro relief. The U.S. labor market just added a shockingly low 57,000 jobs in June. This actually triggered a sharp relief rally, and here's why. It immediately halved the odds of a September Federal Reserve rate hike down to around 50%. And as we know, a lower interest rate environment makes non-yielding assets like Bitcoin way more attractive. Because ultimately, global dollar liquidity, rather than geopolitics, is what currently dictates Bitcoin's overarching trend. While shocks in places like the Strait of Hormuz definitely cause short-term fear, it's the flow of the US dollar and Fed policy that truly steers the ship. As capital seeks new avenues due to shifting rate expectations, Bitcoin acts as a prime liquidity proxy. Simultaneously, we're seeing some powerful institutional adoption milestones that are providing a long-term bullish floor to offset all this crypto-native volatility. The UK, for instance, just launched a comprehensive new regulatory framework to provide real legal certainty for institutional blockchain adoption. At the exact same time, German savings and cooperative banks are rolling out proprietary crypto trading directly to millions of everyday retail customers. The infrastructure is absolutely solidifying. And as the whole AI and crypto convergence matures past the pure hype phase, we're seeing a critical shift. Capital is rotating away from those highly speculative AI tokens and moving toward projects that provide real, verifiable compute and live utility. Investors are getting smart. They're demanding infrastructure that is actually grounded in real hardware economics.
Act 3, the final standoff.
So for any kind of bullish recovery to happen, the market needs a massive sequential 1-2 punch. First off, institutional demand absolutely has to return, meaning ETF inflows need to reverse that drain. Then, and really only then, can Bitcoin build the strength to decisively push past that resistance zone up to 65,600 and deal with all those trapped buyers. But without that specific catalyst, well, we're likely stuck. The base case scenario for the rest of July is a grinding, frustrating sideways market bouncing erratically between $57,000 and $63,000. You know, it's not cheap enough to trigger aggressive panic buying, but it's also not broken enough to cause total retail capitulation. It is a true no man's land. Yet, if you zoom out for a second, the long-term indicators are screaming opportunity. The data suggests the asset is currently sitting in a deep valuation discount zone, literally fire sale territory relative to its historical growth. For accumulators who are willing to weather this short-term storm, this is a massive opportunity. So here we are, the battlefield is set, the macroeconomic forces are colliding head-on with structural adoption. But the ultimate question remains, will those 62K shields hold, fueled by soft labor data and global liquidity? Or will that $10 billion stablecoin drain and record ETF outflows force a final capitulation? Which side of this critical macroeconomic standoff are you betting on? Thanks so much for joining me for this explainer. I hope it brought at least a little clarity to all this chaos. Keep your eyes on those institutional flows, and I'll catch you in the next one.